Thank you very much. And I'd like to call the meeting of the Kentucky Retirement System Board of Trustees. If I'm not mistaken, this is a special meeting because we moved the date. So a special meeting of the December 5th quarterly board meeting. And with that, I'd like to call the meeting to order.
Would you like the opening statement?
Please.
Okay. For the record, I want to note this is a special meeting of the Kentucky Retirement Systems Board of Trustees. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and are not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date. Thank you.
Thank you very much, Michael. And Sherry, are there any public comment?
There is no public comment. Would you like for me to do roll call?
If you would, I'd appreciate that.
Sure. Ms. Hampton,
Here.
Mr. Atkins, Ms. Bova,
Here.
Ms. Eves,
Here.
Mr. Lane,
Here.
Dr. Miller, Mr. Piercy,
Here.
Mr. Summers,
Here.
and Ms. Thompson.
Here.
Thank you.
Okay, thank you, Sherry. And the next item on the agenda is the approval of the minutes of November 14th. Are there any comments on the minutes before we ask for a motion? Okay, with that, would someone like to make a motion to approve the minutes?
So moved.
And second?
I second. Mary Eves.
Okay, thank you, Mary. Okay, we have a motion and a second. All those that approve the minutes, please say aye.
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 And those opposed? Hearing none, we'll go on to the next item on the agenda, which is the external audit. And Sherry, do we have, is it Adam? Do we have the state people here for this?
Yes, Mr. Gordon
Yes.
and Ms. Hinton, I think, are here.
Yeah,
Okay.
good morning. So I'm Adam Gordon, if you're ready for me to start.
Please.
All right, thanks. So like you said, I'm from the Auditor of Public Accounts, and I'm the auditor in charge of this fiscal year 23 audit. Linda Hinton, who is the audit manager, is also on the call. So as you may know, the Kentucky Revised Statute requires that at least once every 5 years, the APA performs the retirement system audit. So our last audit was in fiscal year 18, and then so now this year is fiscal year 23. Management is still responsible for the preparation and fair presentation of the financial statements as it relates to our audit. So we audited the ACFR prepared by KPPA and provided management with our audit opinion in the government auditing standards, also known as Yellow Book letter, for the inclusion in the ACFR. Our end of field work for the audit was November 27th, the date of the KPPA audit committee. So the letters will be dated on the 27th of November. We will provide those letters to KPPA management once the ACFR has been approved by the full KPPA board meeting tomorrow, Wednesday, December 6th. So we only expect formatting changes to occur on the ACFR. So if there are any other changes, we ask that management let us know what those changes are. And then once we receive those changes, we'll review them. But if there is anything significant, we may need to open our end of field work date if there is anything. So far, I haven't seen any significant changes as of right now. So once we find no changes, I'll send KPPA management the final letters that will be signed and can be released in the ACFR after the meeting tomorrow. So KPPA is a component unit of the Commonwealth of Kentucky. The audit of KPPA's ACFR must be finalized before the release of the Commonwealth's ACFR, which is normally in the middle of December. I think that may be one of the reasons why you had the special meeting today, just so you could have it before the KPPA would approve the release of the ACFR, so you all could review it and make any changes if needed. So Sherry, if you want to go to page 284, I believe, that should be those charged with governance letter. So as part of our audit, we are required to communicate to those charged with governance certain topics, including a description of our responsibilities, the plan scope, which is expressing an opinion on the financial statements, significant accounting practices or estimates, misstatements, difficulties encountered, and findings or other issues. So we'll be emailing this letter to Mr. Piercy, who is the chair of the KPPA board and the KPPA audit committee, and who can then distribute this letter to the rest of the members. But just a preview of this letter, we didn't note any unusual items. So on page 23 will be our draft opinion. So we are issuing an unmodified or clean opinion, and our opinion letter will include 2 unusual paragraphs just from prior years. So our office likes to include an emphasis amount of paragraph for component units of the Commonwealth to emphasize that our opinion is solely on the component unit, which KPPA's ACFR, and not the Commonwealth's ACFR. And then we have another paragraph referring to the 2022 audit, just stating that it was performed by other auditors than ourselves. So, and that the 2022 information is presented for as comparative information in the report. All right, so page 36 is the start of the financial statements that we audited. So I'm going to defer most of the kind of performance of the statements that is detailed in the MD&A to management, but I just wanted to highlight just some things related just for the KRS board, which is the KERS, hazardous and non-hazardous and state police retirement systems. So for pension, the total fiduciary net position is 5.1 billion for those 3 funds, which is roughly a 700 million increase for pension. Total investments increased roughly about 500 million for pension. Net investment income increased by 500 million for pension compared to last year's net investment loss. And then benefit payments and total pension contributions remained relatively the same from the prior year, with just slight increases in 2023. And then for insurance, the total fiduciary net position is 2.3 billion. That is a 2 million increase from the prior year for insurance. Total investments increased roughly 500 million as well for insurance. And then the same for net investment income, increased 500 million for insurance, or 400 million, I should say, for insurance compared to last year's net investment loss. So this year, there was a great increase for the investments overall. So, all right, next we'll go to the findings, which is page 277. So our findings are classified as material weaknesses, significant deficiencies, or control deficiencies. We as the auditors determine how a finding should be classified based on the likelihood of misstatement and magnitude of a misstatement that occurred or could occur. Control deficiencies appear in the management letter for action as management sees necessary, while material weaknesses and significant deficiencies appear in the audit report. So if you notice in our audit report that we had no findings that were required to be reported. So the only two items we noted were control deficiencies, and these were included in a management letter that we'll send to KPPA management. So the first one that we had is regarding investment reconciliations. So essentially what we were doing when we were reviewing the reconciliations performed from the custodial bank and the accounting system, we noticed that the review, it was difficult to determine when something was reviewed or if it had just been carried forward from the previous month. So essentially we just asked and recommended that KPPA update their review procedures to include more concrete evidence to say when something was reviewed. And actually, when I brought this to management, they were already aware and had updated the procedures for 2024. But since we were auditing 2023, we went ahead and included this recommendation in the management letter. So. And then the second issue, which is, I believe, 280. This one is regarding healthcare premium wires. So we were reviewing monthly healthcare premium payments to Humana and Department of Employee Insurance. And essentially what we had found for 3 months that there was payments coming out of the incorrect plans. But overall, the net difference ended up just being about $30 all in all. So again, that's why we determined that it was not significant based on that amount. But we brought this issue to management, and they have since corrected this for the financial statements and are updating their procedures for 2024. And with that, that's my presentation. I would like to thank all of KPPA's management and staff who worked with us. They made it they helped make our audit very efficient. They came to us with anything that may be potential issues and were willing to work through us on any other items that we had on the ACFR. So we greatly appreciate their help on this. So are there any questions for me and Linda?
Any questions? Adam, I think this is the third time you've presented these, if I'm not mistaken, and at least one more with us, and you might present to PPOB also. I'm not sure about that.
Yeah,
but
I'm not sure about that, but I know I'll be presenting tomorrow at the full board meeting, just to make sure we can get the ACFR approved to be released. But I think that's it. But I'll be happy to speak if you all need me to on anything else.
I want to thank you for your for the work, for the professionalism, and also all the things that you've said about our staff. So with that, I would like to have a motion. Basically, what we're doing is accepting this, and the motion would be to accept the fiscal year 2030-23 external audit report as presented, including the recommendations and the management response. So can I have a motion?
I move, Lynn, Mary Eve, so moved.
Thank you, Mary. Thank you, Mary. Is there a second?
I'll second.
Okay, thank you, Keith. And all those in favor?
Aye.
Aye.
All opposed? Hearing none, the motion is passed. Thank you very much again, Adam, and the whole team.
All right, thank you.
Okay, so now we go to the actuarial evaluation by, and this will be our actuaries with KRS. And Danny and Janie?
Yes, thank you. I think if we could go ahead and go to, I think it's page 297 of the board books. Yes. We went through this whole presentation in depth in November, so I'm not going to go through the whole thing with the board again today. I just wanted to highlight this slide right here. This is the employer required contribution rates that were calculated with the June 30, 2023 actuarial evaluation. These rates, you can see that would be columns 3, 5, and 7 on this slide. These rates would go into effect July 1st, 2024, and would be in effect for 2 years. So that's fiscal year ending 2025 and fiscal year ending 2026. You can see for the hazardous plan, the K hazardous plan and the state police plan, a significant decrease in the rates there, mainly driven by the significant increases in the covered payroll that we saw. And on the K non-hazardous plan, we can see a 49 million decrease in the amortization cost. Two main drivers there. One is the assumption changes in the experience study, and then also the additional appropriations that we saw from the General Assembly. So that's really all I have for the board today, but I'm happy to go in anything in more depth if the board would like, or answer any questions.
Hey, are there any questions of Janie or Danny? If there are no questions, can we have a motion to approve the June 30th, 23 actuarial evaluation as presented? So is there a motion?
So moved.
I'll make the
Thank you,
motion to approve.
Okay, I've got a motion from Keith. You want to change that to a second, Pruitt?
That's fine.
Okay, thank you. Okay, so any further discussion? If not, all in favor, please say aye.
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 Aye. Opposed? Hearing none, the motion is adopted. So the next item on the agenda is the fiscal 25-26 contribution rates. And this is John Chilton. I think I'm sure he's on.
These are the contribution rates for the upcoming fiscal years. That actually, I thought GRS was going to present these, but I will. These are the payroll rates, the normal cost rates for hazardous, non-hazardous, and state police. The pension amounts for the underfunding are a fixed percentage for each of the employers. And there's the employer contribution rates. For the non-hazardous, the pension and the insurance rate is a 9.44% amount, plus the amount to pay off the unfunded liability. For the hazardous, the total rate is 23.74%, nothing for insurance because of the funding level. And the normal cost is included in the pension amounts. So the employer contribution rate based on their current payroll is 23.74% for the hazardous employers. The state police employers, the pension amount is 65.9%, insurance 2.31%, so the total is 68.10%, the normal cost being included in the pension contribution for the state police. So those are the rates that are being suggested for the upcoming biennium and are consistent with what the methodology that we've used in the past.
John, could I make a comment?
Please.
Yeah, for the newer trustees, we had contribution rates beginning particularly in 2019, it escalated significantly in order to, because the assumptions were made more realistic, requiring more contributions. But employers really felt the pain of that. And by way of an extreme example, the state police rate 3 years ago was 147% of pay. So if they had a new trooper at $50,000, they're paying another over $75,000 to or close to it to us for pension cost. And with a significant appropriation from the legislature, we've got that down to 68% now. And I think Keith could probably speak to it, but the money that's been freed up, they can use for other causes like pay increases for troopers. But we're showing real progress in both the C and the K in terms of getting contributions down and the funded status up, and it's additional appropriations that help. It's more realistic assumptions, and those are the two keys. So thanks to the trustees for the latter.
Thank you very much, Dave. Does anyone have any questions on this? I have one. Can you tell me the employer contribution rates last year, the last time we changed them?
I cannot off the top of my head, but they're very similar. Dave, do you have those?
I can answer that question.
Okay, good. Jane.
So the employer contribution rates for the last fiscal year. Sorry, I'm just pulling them up to make sure I get the exact ones. So the for the KHAS, it was 31.82%. And for the state police, it was 85.32%. And I'm sorry, I don't have the K non-hazardous normal cost rate right in front of me, but it was around 9%.
Sherry,
Thank
they're
you,
on
Jamie.
page 297 of the board books. They're in the presentation that Jenny. These are the pieces that you'd already seen.
Okay, yeah.
Here's the 22 rates and the 23 rates side by side.
I think that really puts an explanation point on what Dave was saying. So Steve and crew and Pruitt, Ramsey, I mean, everybody on the investment committee, and good work. And also, obviously, the governor and the legislature. Okay, any other questions?
I have one comment.
Please.
Back on the contribution rates, back on page 505. At the bottom, it says the ALC, the unfunded amounts are in Appendix D, but that did not get updated. So you did not see an Appendix D. You had Appendix D with nothing behind it. So
Okay.
I will get that corrected and get that out to you guys. That Appendix D would give a list of all of the KRS non-hazardous agencies and their percentage and their amounts that they're going to pay for the biennium for the unfunded piece.
Thanks, Rebecca, for pointing that out. Okay, I think with this, we can take a motion, and the motion would be to approve the FY 25-26 contribution rates. So is there a motion?
It's Mary. I so move.
Thank you, Mary. Second?
I'll second.
Thanks, Pruitt. Any further discussion? Okay, all those in favor, please say aye.
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 Opposed? Any opposed? Okay, with that, the motion is adopted, and thank you very much. So Steve, since we just talked about what you were doing, would you like to give the quarterly investment performance report?
Sure. If we could share, if you could go to page 509, please. The Kentucky Retirement Systems Investment Committee held a regularly scheduled meeting on November 9th. No recommendations were made that required approval by the investment committee, and no actions were taken that required ratification by the KRS Board of Trustees. I'm going to give a very brief overview and some highlights of the first quarter of the fiscal year. Obviously, that was an eon ago in market terms, and then provide a very brief update on the two subsequent months to get us up to date. So page 509, markets struggled for direction in the quarter as they faced a multitude of headwinds, resulting in simultaneous declines in equities and bonds, driven largely by markets recalibrating at the time to the likelihood of U.S. interest rates remaining higher for longer on the back of a lot of Fed speak and incoming market data. US public equities had their worst month of the year in September, down almost 5%, and ended the quarter down 3%. Global equities were down almost 4% for the quarter. The biggest driver, the yield for the US 10-year benchmark, rose by 73 basis points during the quarter to its highest level since 2007. And that was driven by a 59 basis point in real yields, which resulted in core fixed income declining 3.2% during the quarter. High yield bonds and leveraged loans fared better, owing partially to their lower rate sensitivity, with bonds down only 46 basis points for the quarter and loans actually gaining 3.1%. Page 526, please. The KRS pension composite produced a return of minus 94 basis points for the quarter. The KERS and SPRS pension portfolios returned minus 89 and minus 92 basis points, while the KERS hazardous pension portfolio returned minus 114 basis points for the quarter. The KRS insurance composite produced a return of minus 123 basis points, with portfolio performance ranging from down 108 to down 130 basis points. Markets continued to struggle in October, with gross assets down globally as risk found limited support. US equities dropped over 2.5% during the month, their third monthly loss in a row, with 10 of 11 of the major sectors closing in the red. Energy and high beta were particularly hit hard, dropping 6% and 8% respectively, while utilities was the only sector that was up, and up 95 basis points for the month. Global equities fared even worse than those in the US, falling over 4% for the month. Traditional defensive assets also produced losses for the month, as we saw in the last quarter, as yields continued to rise across the curve. Core bonds were down over 150 basis points for the month. High yield bonds were down a little over 1%, and leveraged loans, again, owing to their shorter duration, were flat. Real assets also dropped during the month, with real estate, infrastructure, MLPs all down, and broad commodities also suffered losses, with oil down over 11% for the month.
Steve, are you frozen? I think so.
Portfolios. Turn the page. The world has changed in November. We've seen a tremendous relief rally across financial assets. If markets have embraced both the presumptive end of Fed tightening and the expectations of a Fed pivot, along with positive seasonality. As we've seen, we've shifted from expectations of rates being maintained throughout much of 2024 to currently pricing in over 150 basis points of Fed cuts before the end of 2024. Rates fell during the month of November, with 10-year US Treasury yields dropping by 60 basis points. In fact, a traditional 60-40 portfolio, what we think of as kind of that traditional balanced portfolio, was up over 7% during the month. And that's the third best month for a balanced strategy since before the great financial crisis. Markets across the board have participated in the rally, with US and global equities up over 9% for the month. The VIX volatility index collapsed to end November just inside of 13, its lowest level in more than a year, and down from over 18 at the end of October. Core and high yield bonds also participated in the rally, up over 450 basis points for the month. Real assets were mixed, but mostly up during the month. However, commodities continued to lag and were down over 2% for the month, with oil down over 6%. While November performance is very preliminary, portfolios are indicated up between 4 and 5% for the month. Page 545, please. This is again is data as of the end of September. All of the portfolios continue to produce strong risk-adjusted returns compared to the Wilshire Peer universe, with longer-term performance in the top decile or top quartile across portfolios. And risk for all of the portfolios, as is consistent, is in the lowest decile for all time periods. So again, speaks to across all of the portfolios and the different asset allocations, we've been able to produce very strong risk-adjusted performance. Again, that is driven largely by the asset allocation that the investment committee and the board has provided us, as well as asset allocation within that framework that staff does, and the underlying performance of our managers. Page 557. From an attribution perspective, I know this came up at the last meeting, specifically for the asset allocations that were outside of the prescribed range during the quarter. The impact to performance was minimal. That's partially attributable to what we're using as our proxies. And they contributed from between positive 21 basis points to minus 12 basis points for the quarter. So that's those asset allocations that are outside of the ranges prescribed in the IPS. What's the impact of being outside of that range? And again, for the quarter, partially attributable to what we're using as proxy asset classes, it was fairly minimal impact despite the level of volatility that we saw in the markets. Since the end of the quarter, new capital commitments in real estate have been made that were made earlier this year were called for the KRS and SPRS pension portfolios and KRS insurance portfolio. And the capital called range from 75 to 200 basis points for our real estate allocation. The new real return mandates, we continue to make progress in moving towards targets as they've continued to call capital, moving the portfolios closer to those targets and closer to the ranges. One of the new mandates that was approved earlier this year called approximately 76% of the capital that we had committed, 190 million total of our commitment in October. So as we see on here, we've included for the investment committee a look at a pro forma basis of what our allocations would be if the capital that we have committed, that we viewed as having a high probability of being called, was immediately called. So obviously this will take time for those managers to call that capital. But we have excluded capital that is committed but uncalled, but where we view a very low probability. Sometimes as we're ending the investment term or outside of the investment term, but they're still recallable capital, we view some of that capital as having a very low probability of being called, so we didn't include it in these graphs. I'll pause there for questions if there's anything specific anyone wants to ask.
Any questions, Steve? Steve, I have a question on cash.
Yes.
Can you, now with these commitments that you've made, has that moved back into policy?
So cash is within the range. We are, if you see how for specifically for the two pension portfolios where we have the largest variance from ranges, we're not within the range yet. We still, if all of our capital were to be called today, we would be just outside of the range. So we need to have additional commitments. Part of the discussion that we've had is both that's allocated towards, the combination of what we see across where we're overweight and the combination of cash serving as a proxy for those asset classes where we're outside of the range or below targets. We're also in a very fortunate position where our liquidity program currently is yielding about 5.5%. So the opportunity cost of maintaining that cash position, it's not very high at the moment. As rates come down, we would anticipate to draw down that cash, especially as we fund additional commitments.
Okay, thanks for that explanation. Anything else on anybody for Steve?
Steve, this is Mary Eves. Are
Yes.
the situations where we're outside the policy lean more toward the outside managers or the inside managers, or does it matter?
Well, most of where we're outside. So if we look at, and that's outside of the range, which tends to be real estate and real return, those, and to some extent private equity, but much smaller, those tend to be external managers. And as the pro forma tries to show, some of those are cases where we have committed capital. So we may have committed, $150 million to a manager, and we're waiting for that capital to be called. In the case of the real estate, where we recently had 75 to 200 basis points called, those commitments were made at the beginning of the year. So it can take several quarters. Again, we tend not to to push our external managers to deploy capital. We really want them to be prudent. We're obviously cognizant and aware of market conditions, and they are investing for the long term. So we certainly don't want them to. We see that with some other external funds that we don't necessarily invest in that have very large capital raises and they are very quick to deploy capital. Our manager's been very prudent in doing so. And again, we were fortunate in the real asset space that two of our managers have been very quick. There wasn't a significant queue, and there was investment opportunities that were very immediate. So they've been able to call capital quickly. One of the other newer managers, it's been a slower grind to get capital called. So it can take several quarters, and that's part of our discussion when we make changes to our asset allocation, especially for private asset classes. It can take some time to fund those. So what we tend to do is we look at more liquid securities as a proxy, and we invest in liquid securities. That can be a combination of certain securities that we think gives a good approximation of the risk return profile until those commitments get fully funded.
Thank you.
You're welcome.
Anything else for Steve? Okay, Steve, please.
I was very, very quickly going to touch on 573. This is our compliance report that we continue to work on, and we're in the process of doing a comprehensive review and reconciliation of the rules and restrictions that are coded into the BNY outsourced compliance module. That's what we utilize on a daily basis to review compliance of the portfolios. And we want to make sure that, it's been around for a while. There's been changes to statutes to IPS. We want to make sure that all the appropriate statutes, IPS, and guidelines restrictions are being coded and tested on a daily basis. So we hope to see some enhancements over the next year in this process, but obviously happy to report that there were no reported compliance violations as of September 30. And also, this is for the first time, just last month, we posted the first proxy voting report to the website. So that's in compliance with the new statute. So, as I mentioned, as of 6:30 or 7/1, all of the proxies that we're eligible for to vote are being voted in accordance with the KRS and SBRS voting proxy policy, And for the first time, we actually were able to post that report of all of the proxies voted to the website. The only other thing I wanted to touch on was part of the discussion at the investment committee meeting was we provided an update on the asset liability and asset allocation study that we're working hard on with Wilshire, are being voted in accordance with the KRS and SBRS voting. The current market environment is very different, I'm sure, as we're all aware, than that of 2020 when the last asset allocation was implemented. The significant changes in asset class assumptions, especially for those asset classes with a yield component, since that modeling work was completed, means that we have an opportunity to make adjustments to the current asset allocation targets, which we believe will maintain the expected levels of returns, but meaningfully reduces the expected risk and volatility of the portfolios while maintaining the current liquidity profile. So we're excited by the opportunity. We're anticipating having a special called meeting in January where we will present the findings as well as make recommendations to the IPS asset allocation targets.
Steve, is that special meeting of the investment committee?
Yes. So the process will be, we'll make the recommendation to the investment committee, they'll vote. And if they were to approve a recommended changes, it will be brought to the board for ratification.
Thank you.
You're welcome.
Further questions? Hey, Steve, thank you very much for the results and the report.
Thank you.
Okay, now we have, I guess, Mike Lamb on the quarterly financial statements and contribution reports, outstanding invoices, and penalty waiver.
Thanks, Ms. Hampton. So we're on page 602, and near the bottom of that page, you'll see that the fiduciary net position at the end of quarter one for all three of these plans is at $5.1 billion. That's 16.33% higher than the first quarter 2023 amount of $4.4 billion. That's $722 million higher and is driven by 14.81% increase in total investments at fair value. specifically in the public equities, which is outlined a little bit in note 4, and core fixed income. In addition, the short-term investments are up 27.99% or $211 million. If we page down to page 603, despite this increase in fiduciary net position from 630 to 930, we only had $41.6 million in change from 630 to 930. That's income. And in the first quarter of the prior year, we actually lost $26.9 million. That's a $68 million improvement. And as Steve just discussed, we had a few rough months this first quarter, but it looks like things are turning around in November, and hopefully December will be better than November. If we look at the top of this page, you'll see that we received $390 million in contributions total for all 3 plans. And we did pay out $300 million in benefits, if you scroll down just a little bit there, in benefits, refunds, and admin expenses. That's a $90 million cash flow gain. Prior year quarter 1 was a $78 million cash flow gain. We did have net investment loss for the quarter of $48 million compared to a net investment loss of $105 million in the prior year's first quarter. If we carry this on to page 604, we can discuss a little bit more in the contribution reports. If you look at that yellow highlighted line, you'll see that the 3 plans reported net positive contributions of $108.4 million, $11.4 million, and $5.7 million respectively. In total, that was $125.5 million. In addition, if we remove the net investment income, that's 25.2, 5.7, and 4.6. All 3 plans have a positive net cash flow for the quarter of 83.2, 5.8, and 1.2. The member contributions are up 4.8 million. Employer and employer pay credit is up in total by 10.6 million, while the AALC is down 2 million. The general fund appropriation amount has remained flat, and total outflows were consistent across all 3 plans. There was an unrealized gain, or in this case, a loss for all 3 plans, 38.8 million, 15.8 million, and 7.5 million, but they were not as bad as the prior year's first quarter unrealized loss. That's what I have on the pension statements. If there's no questions, I'll move on to the insurance statements.
Any questions? Please, Mike.
So similar to the pension statements, the fiduciary net position at the end of quarter 1 for fiscal year 24 for all 3 plans is $2.3 billion. That's 12.67% higher than the first quarter amount of $2.1 billion. It's driven by the 14.84% increase in total investments at fair value, most notably in public equities. If we then scroll down to page 606, you'll see that this increase in fiduciary net position year over year did not result, well, if we look at just the first quarter results, we have a $9 million loss in the change in fiduciary net position. And in quarter 1 of the prior year, we actually lost $53 million. So we're doing much better this first quarter than we were last year's first quarter. We did receive $49 million in contributions and paid out $30 million, mostly in healthcare premiums, for a $19 million cash flow gain, while the prior quarter 1 was $2.5 million in cash flow loss. In addition, the net investment loss for the quarter is $28.7 million, and the prior year quarter 1 net investment loss was $50.6 million. If we then move to the contribution report for the K plans, you'll see that little highlighted yellow line. We were positive 32.7, no change for the hazardous, and positive 0.9 for the state police. That's 33.6 million in total. If we remove the net investment income of 9.8 million, 3.2 million, and 1.3 million, the K hazardous and the state police plans have a negative cash flow for the quarter of 3.2 million negative and 0.4 million negative, and whereas the non-hazardous plan has a positive cash flow of 22.9 million. that's what I have on the financials for the K plans. I think the next slide is the outstanding invoices by employer. If you look at the grand total for 9/30, we're at 4.5 million, whereas at the end of 6/30, we were at $5.2 million. We also list the top 10 employers that have outstanding invoices. And I wanted to mention that we've started starring these invoices that are in litigation, but the wording of that needs to be corrected. So they're not all in litigation, but they have been either referred to legal for further collection activity and or are in litigation with legal. So we'll correct that wording there, but we wanted to start identifying the employers that have outstanding invoices that have been referred to our legal department for further action. Any questions on that? If not, we'll go to the penalty invoice report. So for the quarter, we had 4 penalty invoices that were waived for a total of $4,000. We had 4 penalty invoices that were created for $4,000, and we had 7 penalty invoices that were paid, totaling $7,000. Next is the admin budget. So what I've done here is I've inserted a high-level summary page, and I presented this to the C board yesterday and had some discussion on that. My intent was to discuss this high-level summary admin budget and put the detail in the appendix of the board books. A couple reasons. One, I think we had discussions early in the board task force meeting, the board budget task force, about detailing out the legal contracts and the legal firms and this, that, and the other. So let me just go ahead and present this for a minute, and then we can discuss how you may want to see this going forward. So even though this is highly summarized, I would still discuss line items that are out of whack or not in compliance with what we expect or our budget. So this particular first quarter, if you just look at this first line, the personnel line item, we spent $8.1 million. That's, about 24%, which is right on line with the quarter. And then if you look at the legal contracts line item, we've only spent about 14% so far. However, within that legal contract line item, we do have the legal hearing officer line item, and we've already spent 33% of that budget. We did increase that budget. There are a backload of cases, and we currently have 3 hearing officers. As you know, in the past, we've increased their salaries or their hourly rates, and they're staying pretty busy with our backlog of cases. So I think that's why it's up a little higher than normally for the first quarter. But because we've increased that budget, we kind of anticipate still staying in line with it overall on a year-to-year basis. The auditing line item, there's no expenses there yet. The APA has not yet billed us for the ACFR, so that's coming forth soon. And in this other personnel line item, there is some miscellaneous items, including $66,000 to Provaliant for our strategic plan. So that total gray line personnel category, we've spent $8.5 million, and we still have, it's at 76% left to spend, which is right on line in total for the first quarter. And then as we look at the operational subtotal, we've spent $1.1 million. That's, we still have 84% left to spend. There are a few items in here that fall into a detail category for miscellaneous, and that included $5,000 in furniture moves and $8,000 from the personnel cabinet for their annual board assessments. But besides that, there was no other line items that, in my opinion, needed discussion. So that would be my presentation going forward on these quarterly meetings. If you page down, Sherry, the board members can see the detail that's always been presented. And my thought was to maybe just keep that in the appendix. I will let you know that the trustees from the C board still wanted these here, and they wanted them right near the summary, so they didn't have to look for them. So I will probably include a summary tab or summary page, evaluate that summary page, and leave these 2 pages for you guys to review ahead of time or look at more specific questions if you'd like. But I'm open to discussion.
Mike, on the percentage difference, just to clarify, that is can you clarify what that is a percentage difference of?
So that's the
column.
comparison to the fiscal year 24 expense and fiscal year 23 expense. So I think it's the difference between those 2 amounts as a percentage. So for example, the salary and wages this quarter at 4.4 was 9.34% higher than last year's first quarter. That's particularly due to the raises that were given to all statewide employees.
Okay, so this is, in this case, it's a fiscal year to fiscal year, but it's also a quarter to quarter, but it will continue to be fiscal year to fiscal year. Is that right?
Correct. Yeah. So next
Okay.
quarter, you'll see 6 months results compared to 6 months prior year
Okay.
results.
Okay, thanks. Does anybody else have any questions? And are you, can you go back to the summary report, Mike or Sherry? Okay. Okay, are you all comfortable with this and the explanation? Does anyone want any more detail? Are you comfortable with the summary reports? I hear no objection, Mike. So it sounds like we would be pleased with the summary report. Okay.
Yeah, go ahead
Anything
and,
else?
and I'll continue with some of the other charts related to this, if that's okay.
Please.
Yeah, sure. If you page down to the bottom of the next page, I will still continue to include this breakout by plan based on the hybrid percentage. That kind of shows how much the K plans out of that total admin spend is being allocated. In addition, if you page down to the next page, we'll talk about the Chase fees and interest. And I know I owe Ms. Bova, as well as many other trustees, other things. I do want to give an update of what I've been working on. The fees that we get charged from Chase, they are contractual. They're part of the master agreement with the Commonwealth. So there's a whole chart of those fees, including, a monthly service fee for each account that you have. There's a fee for each transaction, whether it's ACH or check. There's a myriad of other fees. And in fact, there's probably like 20 of them. I've been reviewing those fees for the last 18 months that we've been charged. On average, they come around $7,000 or $8,000 a month, depending on the activity in all 12 of our accounts at JP Morgan Chase. They're not out of line with what's in the contract. And there was 2 ways we could pay for those fees in that initial master agreement. The first way, which is how our accounts were set up, was we would have an earnings credit based on the balances in our JP Morgan Chase accounts. That earnings credit was a low interest rate. And if that credit was higher than the fees, then we weren't charged any fees. They just offset each other. If the interest was higher, we didn't get that extra interest. However, if the interest was lower, and so, about 12 months ago when the interest rates were really low, we started getting an invoice for the fees that our interest credit did not account for us. So that started the process of us looking at what we're being charged, why we're getting charged, etc. And so we started converting our accounts away from that method to a hard-earned interest method. The hard-earned interest method is a higher interest rate, and all of that money that's earned is credited to our accounts on the last day of the month. The fees then accumulate, and we will get an invoice for the fees at the end of the year. So as of last quarter, we had converted all of those accounts into hard interest. And if you scroll down just a little bit, Sherry, you can see the interest earnings that happened in July, August, and September. And the rates that were being credited now are higher. And then the fees are still, around $7,000, $8,000 a month, and we will get an invoice for them at the end. What I plan to do, hopefully by the February board meetings, is to show the trustees, a historical presentation of all these fees and what we plan on doing going forward. We're still evaluating the balances in these accounts, what should be in there, how do we keep it lower, so that more of those funds can be invested by Steve and his group, etc. So that I just wanted to give a verbal update of where I'm at. I know there's been a lot of questions on the Chase accounts and the fees and how the money's handled with them. So
Ramsey, you have your hand up?
Yes, so in terms of the contract that we have with JP Morgan, when was that signed or put into effect? And can we look at that or change that?
so it was they've been our depository bank for several years. They actually have
How many
one,
is several? Sorry, I'm just,
I want to say like 10.
okay.
Yeah. It's a master agreement through the state. So the RFP went through the state, and in fact, they have a new RFP that just closed at the end of October. And there is a group of people evaluating the new bidders to determine if we will go away from Chase. Chase does have one more renewal on their contract that the state can execute. So that would take them through 2 more years. Or they can take the bidders here and choose someone else and or Chase. But that process is going to take several months. We really don't have any additional negotiating power with Chase outside of that because we're part of that master agreement, as well as the teachers programs part of that master agreement, and as unemployment insurance is also part of that master agreement. So they all kind of follow the same rules that we have that we're following related to this Chase contract.
Got it. So we're pretty much, I mean, this is it, unless there's some sort of legislative change.
Yes, and I've had some discussions with the finance group. Like, I posed a question that said, hey, what if the pension plan wanted to go do their own depository bank outside of Chase? What would that do? And, they really didn't know if that was possible. They said we'd probably have to look at the statutes to determine that. Internally, my group has some issues with that because we actually get a lot of benefit from the finance group. There's a few people at finance that do a lot of stuff for us related to these Chase accounts that we would have to absorb internally if we were not using Chase or whoever the depository bank is for the state. So that would be an administrative change for us that would probably be complicated. A lot of the payments come out of Chase, right? So all of our payments go through the EMARS state system and get paid. And so the payroll also kind of comes out of our Chase accounts. So there's a lot of things that would happen that would cause the KPPA staff a lot of changes that we're not used to doing.
Got it. Thank you.
Can I ask a question?
Yes, sir.
Please.
Let me ask you something. But when that RFP goes out, does the state get input from us from the things that we would want and like to desire to see in some of the things that Chase is doing, and along with, possible, fees and what should be paid and what could be too high, or does the state just run with that and we have no input?
So let me tell you what I can tell you. The RFP it's closed. It's went out. As far as I know, no one at KPPA had input into that RFP, but the finance group did. I do know that KPPA does have some input in evaluating the responses to that RFP, and will have input in helping decide who the best vendor is for that. So we do have input on evaluating them and on the vendors related to their responses to the RFP.
Well, I'm glad that we have that, but it could be prudent to maybe try to get on the front end of that too. If we haven't done that in the past, but maybe that's something that we could look to possibly do, but definitely want to keep the input on the back end to see, which one, kind of looks the best, and that would be more, I guess, be better to handle what we need them to do for us.
I completely agree with your statement.
Mike, I have a question on how many other agencies, I guess, or whatever, you are users of Chase, and have any of these others changed from the earned income or earned interest that we're doing here? Are we the only one, or are there others that are now doing earned interest?
So again, I think all the other agencies that are state agencies just run through finance, right? I think the ones that are like us are teachers and the unemployment insurance. And I haven't had discussions with their accounting group to determine if they're using hard-earned interest or the earnings credit process. But that's something I could probably learn over the next few months.
Okay, I would be curious as to, especially Chase, how they're going to redo their fee structure based on what we've done and the activity that we've done. Okay, Michael, do you have anything? Mike, do you have anything else?
I think that was all I had.
Okay, anybody else
Okay.
for questions?
Yeah,
Questions
looks
for
like
Mike?
Miss Eves
Yeah.
has her hand up.
Okay, thank you. Thank you, Sherry.
Yes,
Mary?
Mike, thank you for the report. I know timing has so much to do with expenses and when they're actually charged and in the process. Aside from the audit fees, are there any expenses that you're dreading coming in, or anything we ought to be looking for, contemplating, or historically, has it the 25% for each quarter, has it sort of worked itself out timing wise?
Yeah, and I think you might have missed the budget task force group because you're a newer trustee. We actually did a pretty good review of the past 3 or 4 or 5 years admin expenses, and in preparing the budget for this year, that budget that's presented of like $50 million in total is really what we anticipate spending, and they should be in line with 25% a quarter. The one category that is a little tricky for us is the legal expenses. Sometimes they spike a little more often than others, depending on the activity of the legal things going on. But besides that one, most of them fall in line, at least on a year-to-year basis. Like the auditor fees, for example, are going to be still, we're not getting 25% of them right now, but by the end of the year, we'll be close to 100% spend on that, as well as the actuarial fees, et cetera.
Thank you.
Mike, while you're talking about legal fees, what was the results of the RFP on the legal insurance?
So we've placed a cyber insurance, and we have yet to initiate a fiduciary insurance RFP yet. That's still something that's on our to-do list.
Okay. Does that go through finance?
There's a possibility that it may not, but most likely, yes.
Okay. Okay, thank you very much. So Mary, I think that's one of the things that, since we really don't have any insurance on legal issues, that we really do have to watch closely. Okay, any other questions for Mike? Okay, the next item on the agenda is the annuity rate discussion. And John, this is for you, but I'm gonna kind of lead it out with a little bit of discussion. At our last meeting, we were presented the increase in annuity rates, and we had a long discussion, including there was a few misconceptions. Number one, we thought at that point that CERS had adopted this. We found out later that they had not. They'd actually referred it to us for consideration. There was also some confusion in the way people were looking at this. For example, there were some people that were looking at the rate of the annuity and comparing it to the rate of a guaranteed investment contract, which a guaranteed investment contract is a tenured contract, 20-year contract, where our annuities are in perpetuity for the person's life. So there was some confusion. So in between then and now, we asked for our actuaries to do some additional work, and that is in your book. And a couple of us met with them, Ramsey and me and John, and they went over a number of other things. Yesterday, CERS did meet, and CERS, under the impression that we had not passed it, but we had reviewed it, did pass the rate of the combined rate, the 5.875. They did discuss the fact that that is lower than their investment rate, and it is higher than ours. It is higher than ours, but there is a smaller population in our group that is receiving this annuity rate. And with Steve's good work and the committee's good work, hopefully that we're going to be in the near future, be able to take on a little bit more risk. So that is kind of my summary of what's gone on in between the two meetings. And John, you want to take it from here, or do you want, are there some questions before we go on to John's discussion?
Yeah, let's see if there's any questions on your comments, and then I'll carry on. Hearing no questions, a brief reminder of the issues here. The rates that we use to compute annuity payments to retiring employees is at issue. That fact affects primarily Tier 3 employees, because their amount is not determined with reference to their salary. Their retirement amount is a dollar amount that's accumulated over their time of employment. Tiers 1 and 2 annuity payments are based upon their ending salaries under different formulas, but they're based on the percentages of their salaries according to the statute. So this affects primarily Tier 3 people and people who elect other options than the straight life annuity for the retiring employees. So it's not the entire number of retiring employees that are affected at this point, but it's just primarily, as I said, Tier 3 employees. So in the memorandum, I gave some background and some quotes from KRS about the fact that as we raise the rate, there's some additional financial risk for the funds, the Tier 3 funds. It's not an enormous change in the investment risk, but there is some change in the risk. The recommendation that I made in that memo was to change to the 5.75 for
875.
I reckon,
It's 875, John.
yeah, 5.5. 5.875 for the annuity rate, and keep the 7.5% rate for people who buy purchase time from us to replace the earnings that would be earned on the amount that they're going to contribute, to kind of even up the pot on that. The 5.875 is higher than the assumed rate for the non-hazardous plan, but it's a little bit lower on the hazardous and plan. So that's my recommendation. One of the things we wanted to look at the last meeting is on the following pages. And let's go to the next page there, if you would. The additional, this sheet illustrates the additional annual cost for changing it to 5.875 and the increase in the unfunded liability associated with this change. You can see on the KRS non-hazardous, the increase in the unfunded liability is $14,948. The funded ratio is not affected because it's a fairly minor amount, an extremely minor amount in the context of the underfunding. In addition, down below there on line 16, I'm sorry, the increase in the amortization cost is $1,295 and $4,042 for an increase in the annual contributions. Again,
John, for the record, those are millions, not,
huh?
that's 1.2 million, not 1,200.
Yeah, okay. That's right. These are in thousands, so these are the increase in contribution is $4 million. In the context of the overall finances, these are relatively small amounts. GRS was entirely comfortable with us staying at 5.25, but they're also comfortable with us increasing it to 5.875. So you can see the other amounts on the other plans there, the non-hazardous, hazardous, SPRS, and then the changes on the CERS amounts.
John, if I'm not mistaken, and Pruitt, I think I'm gonna have you in this conversation. One of these days when our funded ratio gets to a level we're comfortable with and we raise our risk and we're comfortable with raising the risk, this issue would go away. Is that correct? Maybe Janie or John or Danny want to answer.
Well, we could change the contribution ratios if we were so inclined.
If we were comfortable with our risk. And then with that sort of thought in mind, I might want Pruitt and the actuarial committee to kind of bounce that around at some point. Where do they think we would feel comfortable? At what funding level would we feel comfortable with in raising our risk tolerance? Is that okay, Pruitt?
It is one of the things that that's not a huge factor here, but as opposed to, you mentioned a guaranteed insurance contract, which has no quote actuarial impact to it or built into it. We would have to take a look primarily at the life expectancy of the category 3 participants to make sure that our bet on their life is consistent with the rest of the pool. I hate to use that term, but it does have an actuarial component to it.
Yeah, I guess my issue, and I'd like other people's opinion too, is I would feel more comfortable with that coming from the actuarial committee than with some endorsement of increasing the risk levels. Dave, you have your hand up?
I would agree with that.
Yeah, just a quick, Pruitt and Steve can elaborate on this, but the last actuarial asset liability study that Wilshire just reviewed, the markets now and their expectations say that we can expect to earn higher returns going forward than we had in the past at the same risk level that we have been maintaining. So there's some good news there that we can have a higher expectation going forward without increasing the risk.
That's correct.
Okay, thanks, Dave. Are there any other questions?
One additional comment is that even if we change the assumed rate of return, there would be a cost associated with increasing the annuity rates from the current 5.25 to any other amount, 5.875. So these costs would continue on and be an additional cost regardless of the rate of return that we assume.
John, I'm a little confused, but I'm a little confused by that statement because what we were saying earlier on CERS is sort of the annuity rate and the investment rate are being the same kind of. And are Janie and Danny on? I think
yes, I'm here. I'm happy to clarify that statement.
I'm moving too much in your area.
No, that's fine. So just to kind of clarify why this has an additional cost of changing the administrative factors. So our valuation, when we project out the future benefits for these tier 3 members, we do base that based on your actual administrative factors. So your actual administrative factors right now are based on the 5 1/4. So no matter what your investment return assumption is right now, if you increase your discount rate for your administrative factors, your projected tier 3 benefits are going to increase. So that is going to have a small increase in your unfunded liability and an increase in your employer contribution requirement, no matter what your investment return assumption is. So if you increase that discount rate for your administrative factors above what it is right now at 5 1/4, it is going to have that cost. Kind of what we're talking about more in terms of a broader look as terms of your investment risk is that K9 has, because we currently assume that your investments are going to earn 5 1/4, there is a greater investment risk because we are assuming that these annuities are going to earn essentially 5.875%. I know the board has talked about raising those investment return assumptions or taking on more investment risk by changing the investment policy. That's certainly a conversation the board can have as these funded ratios have increased. That's certainly something that we can continue to discuss with the actuarial committee. But I did just want to say, and another kind of point I want to point out when we look at these increases in the unfunded liability, when we talk about 15 million, I just kind of want to talk about putting that in totality with the experience study. You know, your experience study decreased your unfunded liability by 691 million. So you really want to kind of look at these changes in your unfunded liability in totality. Does that kind of clear everything up? But I'm happy to answer any more questions.
Thank you, Janie. Any questions? Ramsey, you have your hand up?
Yes. Does it make sense to look at what is the covered payroll of the tier 3 employees?
As far as what percentage of the
as far as an increase in contributions, so an increase in contributions of 4 million, right, doesn't sound a lot if we're talking about a $1.6 billion payroll, but what's the payroll of the tier 3?
I don't have that in front of me right this second. I can look it up for you.
And I don't even know if maybe that doesn't make sense. It just.
But you do make a good point in that, you know, as tier 3 becomes a bigger part of your population, you know, it's going to be a slightly bigger increase as a dollar amount. But again, it's a pretty small percentage of your total contributions, I think, is as a relative of the entire contribution amount.
Okay, and when will the first tier 3 person start retirement?
I believe
We have a few.
we have a few, yeah. They only need 5 years.
They would be people who were outside and then came back into tier 3 because of their hire date. They would have experience previous to their rehire.
If I may, I'll just, the eligibility requirements for a non-HAS tier 3 member is the rule of 87, meaning they have to be at least age 57 and their age in service must equal 87, or they can retire at age 65 if they're vested with 60 months of service credit. So most of the tier 3 retirements that we've seen this far, those people who have reached the age 65 and are vested, having 5 years of service credit. For your hazardous members, it's 25 years of service credit to be eligible to retire.
Erin, do you know how many there are? Sorry,
There are, between all plans, I think it was 235 members have retired in all KC&S plans for tier 3.
So would this percentage affect their payment, their benefit?
No.
No, they stay at the 5.25.
Those who have already retired have the factor in place at the time when they retired was used, and it's based on the 5.25. I would say, and I don't know this for sure, but I would say a majority of those who have retired so far have probably just taken a refund of their account versus annuitizing it over their life.
And did you say the other day that if they do take a refund, they're then not, there's other benefits that they lose?
That's correct. If a member takes a refund for their payment option when they retire, they would forfeit any health insurance benefits that they're eligible for, and the $5,000 death benefit. Now, for Tier 3 members to be eligible for health insurance, they must retire with at least 15 years of service credit before they're eligible to participate. So most of the people who have retired thus far would not have insurance.
And Aaron, and the retirement benefit for those people would be much less generous than Tier 1 and Tier 2.
Yes.
To respond to another statement that Ms. Bova made, the increase in rates, Janie, applied to all employee payroll, not just the Tier 3.
Yes, that's correct.
Yeah. So the contribution rate for Tier 1, 2, and 3 employees are the same. Yep. Okay. One other question for Jane, just to clarify, the increase in the contribution rate, has that been included and embedded in the rates that we just approved?
It has not.
Okay. So if we approve this, it would include changing the rates that we just approved for the future contributions.
That may actually be a question for staff. I don't know the logistics behind whether or not we can change those rates at this time.
Dave,
So it doesn't affect the funding rate, but it would affect the contribution rate by what percentage?
So
and in the future, right?
Right. So this change, if the discount rate for the administrative factors changes, it increases the employer contribution rates. You know, the increase in the amortization cost is 4 million. The increase in the K hazardous rates is 24 basis points, and so on and so forth. But that was not included in our actual valuation, since those were not the administrative factors in effect at the time.
So to answer, I've forgotten who asked now, I'm sorry, Lynn, or whoever that was who asked the question. If you changed the contribution rate now from what you had approved before, I suspect, although I wouldn't know that for sure, but I would suspect that the budget bills would override that back to what we gave them. So per statute, we're required to give them, GRS does it for us, a letter that sets contribution rates, the expected contribution rates, and we do that July 1. GRS does a calculation for that only in odd years. So 2023 is an odd year. So we did an odd year because we're preparing for the next biennium. The Commonwealth is preparing for the next biennium. So in July, we gave them a letter from GRS that anticipated some contribution rates. And then we update that again. We're required by statute to update that by the 1st of October. We tell them that doesn't work for us. We can't give them good numbers by then. We ended up giving them numbers late, I believe the 3rd week of October, maybe the beginning of the 4th week of October. So it's pretty baked in at that point. If you changed it now, I suspect that they would frown on that. So they have an entire process. The Office of State Budget Director has a process for the governor's budget. The Legislative Research Commission has a process for the legislators' budget bill. And then together between those two budget bills, they do some sort of compromise or whatever for the budget bill that passes. But the rates that we provided them probably back in October are pretty baked in, and it would be very difficult for either of those staffs to go back. John could probably speak more to that, having been on that side of the house.
Yeah. Rebecca, I think that was John's question, and it was confusing to me, but about what the contributions rates had to do with the actuarial thing. But let's go to, we got a couple questions up. I think Keith, you were next.
Maybe I've just totally missed it here, but we voted on this last meeting, right?
Right.
Okay, so why are we discussing this again?
Because we voted on it with a misconception of some things, and so we thought we'd bring it back up today with the idea of the potential of rescinding it and revoting.
Okay,
And
the
that's why we also,
misconception was,
that CERS
misconception
had
was we
approved it.
thought, okay,
Yeah.
but
Okay.
now as we sit here, CERS has actually approved it,
Has.
right?
Correct.
So really nothing's changed,
Yesterday.
right?
Yes. Yes.
Now we're in the exact same spot we were in before,
Correct.
right?
But we did
Okay.
ask the actuaries to do some additional work, so we're discussing it for that to either make us more comfortable or less comfortable with the decision. So that's why we're discussing it now. Is that okay, Keith?
I guess, I mean, the exact same situation exists. I mean, the C plan has now approved something, and if we go back and rescind our vote, we're going to devalue our tier 3 retirement again. And I just,
Correct.
I don't get it.
Okay, well, we're just discussing it. I think that's my opinion. Well, I don't want to give my opinion right now. Let's finish this discussion, and I think our vote will be whether we confirm the vote from the last time or want to revisit it. But Dave and then Michael.
Yeah, I may be confused, but this most recent discussion about changing the budget, the number that
Me too.
we're not talking about changing the 5.25 for the evaluation. We're talking only about 5,875 for annuity conversions and service purchases. I mean, that doesn't go back and change what we submitted to the. It may have a minor effect, very minor effect, but.
I'm with you. I was also confused, but I think Janie, has helped with that.
So 5.25 doesn't change.
Right.
For the main valuation purposes.
Right.
5,875 only applies to service purchases and annuity conversion, which affects right now relatively few people and probably doesn't have a significant budget impact. In fact, we can see it's $4 million.
Right.
Today, but to Ramsey's point, it's going to get bigger and bigger as we go forward.
Right. Michael?
No, let Janie go and then I'll speak.
Okay.
I just want to clarify Mr. Eager's point and just make sure we're all clear. So on this sheet that we're seeing right here, so where you see the columns that say current plan, those are the contribution rates that the board just approved. So you can see that's the 844 for the K plan, the 2374, and the 68.10. Those are the contribution rates that the board just approved. And based on my understanding and Rebecca's explanation, those are the contribution rates that would go to the budget. Like Mr. Eager just said, yes, if we change the administrative factors at this point, they will have a slight impact on our actual valuation that will most likely go into effect in next year's valuation. So we'll look at that in the next year's budget or in the next biennium budget. So just to clarify that point.
Thanks. I think one of the things I think about with actuaries, if you push here, it comes out there. That kind of a vision.
Yes, we just want to make sure we're taking into account that we are going to see slightly higher tier 3 benefits in the future, and we want to reflect that in our valuation.
Thank you. Michael?
Yes, I just wanted to mention, I would be remiss if I did not mention this. Amongst all this discussion when this was happening, I had a discussion with Mr. Eager, and something that jumped out to me about it was just a fiduciary view of this, from looking at it from the perspective of, we're assuming our money is going to earn 5.25%, and we're going to annuitize tier 3 retirees at 5.875%. And what does that look like from a fiduciary perspective? I had a quick conversation with their fiduciary counsel on this, and they said that in all respects, these decisions about these things, they need to be reasonable in light of all the circumstances that are surrounding it, and the board needs to be able to document all the reasons for the decisions that they're making. And so I would just say that I think the discussion here today, the thorough discussion we've had here today, does that. And so I know in our typical minutes of board meetings, we've typically been a little more succinct in our board meeting, in our minutes, but I would just ask that the minutes for this portion of the meeting be a little more thorough and detailed for that purpose, so we can reflect the thorough discussion that the board has had on this topic for that purpose.
Thank you, Michael. And by the way, I did notice that Katie had more words in the minutes that we approved before, and I think that was good along the same lines that you're saying. Dave?
Yeah, we haven't had a conversation today about the administrative burden or cost of having two rates, not as opposed to one. And Michael, could you opine, when Ice Miller said you need to take into consideration all the factors, would that be a factor that would influence, that could be used to influence the board to say, let's use one?
Yes.
And the other board has already done 5.875, so we would be inclined to do the same thing.
Yes.
Again, that being one of the factors in that decision.
Yes, that was just all of the factors need to be just part of that. You know, these types of decisions are not made in a vacuum. They are, everything is thrown into the pot from that look of things. And so they just wanted to ensure that that discussion is thorough and reasonable, and from all the considerations, that being one of the many considerations. So.
Thank you, Michael. Mary? Mary, you're.
Sorry, John, in the second part of your recommendation about the 7.5%, is that consistent with what KRS either approved or?
Yes, that's the current rate. And in essence, we're deciding not to change the current rate. 7.5% applies to all the plans.
Thank you.
Well, in respect to what Keith was saying, I really appreciate everybody going over this. There were a lot of questions that happened, and I hope I want to continue to answer questions. So if there's any additional questions, please ask them now. Okay, Michael, with that in mind, should we not change the vote, or should we confirm the vote? What would you recommend on this?
I would recommend we do nothing.
Okay.
As Mr. Piercy was pointing out, we're in the same position. We've adopted, this board has adopted that rate already. Whereas Mr. Chilton just pointed out, we are not changing the 7.5 rate. So there's no need to take any action there, and there's no need to take any action on the 5.875. It was adopted at the November meeting. So this discussion has been thorough and laid it all out. There's no need to take any action here.
Okay, thank you. Let me make sure everybody's comfortable with that. It's not a vote, but if you're not comfortable with moving forward, please raise your hand and we'll hear it. Okay.
Based on the legal counsel, I'm very comfortable with this. Thanks, Michael.
Thank you, William. Anybody else? Okay. Well, thanks for everybody. Thanks for bringing up the questions. And I think it was definitely, it was interesting, and although we have spent a fair amount of time on it, time well spent in order to understand something very complicated. Okay, so the two motions that are here, we don't need to pass. Is that correct? So we'll move forward on the agenda, which comes to you, Michael, on the bylaw revision.
You're on mute.
Thank you, Mr. Chilton. I apologize. I want to start by saying this bylaw revision is minimal, and it is really up to the board of whether they want to make it or not. Since this bylaw revision was proposed, there's been additional research conducted. We have attempted, when it comes to these issues that we're talking about here, and Sherry, this is on, if I can find the right page here in the bylaws.
Section 7.
Yes, I think it's in the area of committees. I think it's in 2.1.
It's on page 627.
Okay.
Board books.
I knew it was section 2.1. I did not know the page number. Since this bylaw revision was proposed after discussion with some people, additional research was conducted, because when it comes to open meetings issues, we would like if we could get the advice being given to this board and KPPA and CERS to be all in line. We want to be, give advice across the board on these issues and be in line with that. So I've worked with CERS counsel on this issue. And in looking at this, the concern arose about this because we have several committees that may have 3 members. And the last sentence that you can see there that is redlined says that any trustee may attend any meeting of any committee of which he or she is not a committee member, but shall not have a vote. And so the concern arose that if we have a 3-person committee and as of a 5-member board, we have a 9-member board, and then we have a 3-person committee, and 2 additional trustees want to attend that are not members. Now we have 5 trustees there. That's a quorum of the board. Public business is being discussed that would violate the Open Meetings Act. And so I offered the revision that you see in the next line, that is, any trustee who wishes to observe a meeting of a committee of which he or she is not a member should do so by watching via live broadcast. That seems to resolve the issue. Some additional research found 2 Attorney General opinions that from 2012 and 2019 that directly answer this question, that say the attendance of non-committee members at a committee meeting of which they're not a member, even if it would constitute a quorum of the board, their appearance alone would not constitute a violation of the Open Meetings Act. But it does include some warnings that if they were to attempt to take over the meeting, or if their discussion, if they were to speak and begin discussing things that were not within the purview of the committee, but were in the purview of the entire board, then that could constitute a violation, because then you've switched it from a committee meeting with its narrow focus to a board meeting without announcing a board meeting. And so I also think that the uniqueness of how we conduct our board meetings now, these opinions were issued in 2012 and 2019 pre-COVID, when the vast majority of board meetings were in person versus now being held by Zoom. At that time, if the public and non-committee member trustees wanted to attend, everyone attended in the same room, sitting in the same boardroom. Now, that trustee would be given the Zoom link to attend, while the public would be watching via the live broadcast. I think the factual circumstances in which these opinions were issued and our factual circumstances today are somewhat different. I can't say it would absolutely lead to a different outcome, but it may. And if you sat through the new trustee orientation with me, you know that my approach to these open meetings and open records issues is always going to be a conservative one, unless there is something that is major to be gained by taking an aggressive approach. In this instance, I don't see that there's something that is to be gained by taking an aggressive approach to this issue. So I'm taking a conservative approach. So my recommendation is that this bylaw amendment be made. But because of those outstanding AG opinions, it truly is the decision of this board if they want to adopt it or not. But I do take a conservative approach to these for those reasons, and that's my recommendation. But I wanted to lay that all out for the board so they would know where we stand in the research that's been conducted since this was proposed.
Thank you, Michael. Let me see if there are any questions. Michael, I had a question. Does this also mean you can't, is it taking away something from the trustees that normal people have? In other words, you can go to, when we meet in person, and I assume at some point in time we will meet in person, I don't know how that happens. Where does the public sit when there is a meeting? Do they sit in the boardroom? Never been to one.
I've never attended a full board meeting in person here. I started working here during COVID.
They do.
My understanding is they sat in the boardroom, in the chairs, against the wall, away from the board, and the public sat there. A trustee would be more than welcome to attend those meetings. And, that again, to me, that is because that factual scenario is different, because then that trustee is just like a member of the public. In this scenario, they're different. And I'm not saying they aren't different. They are a trustee, but for that particular committee, they are not a member of that committee. I think that's the difference.
I guess I don't see that. It says any trustee who wishes to observe a meeting should do by watching live broadcast.
Yep.
So I don't.
Yep. Well, and if that's adopted, they would be treated just like the public, in that they would be watching via live broadcast just like the rest of the public would be.
You mean if you attend in person, you define that as a live broadcast?
No. If we attend in person, if we would go back to live in-person meetings, then they could attend in person. If we're no longer doing the teleconference meetings.
I guess I don't see that, but you're our attorney. Anybody else have any comments on this?
I do. I just had a question. Michael, in your opening statement, don't you say the public is also invited to attend at 1260 Louisville Road?
Yes.
So why can't a trustee show up and go sit in the boardroom?
I'm not saying that they can't. What my biggest concern here is that, again, it's a very conservative approach. My biggest concern here is that if we have non-committee member trustees present, if they show up and they simply sit quietly and don't speak, or if they speak and it is specifically on the topic of which the committee member is, the committee is talking about that topic, that is within the rules of the AG opinions that are out there. The risk we run is if those discussions veer off and become more in line with something that should be in the purview of the full board and not that committee, we run that risk. Taking the conservative approach, we avoid that altogether by saying, if you want to watch what's happening in another committee, watch like the public does. If the public were to show up now and they sat in the boardroom, right now, there's nobody in the boardroom. There's no trustees present in the boardroom.
They sit in the lobbies, just so you'll know. That's where public can view them right now.
Currently.
Yeah. Yes.
But if a member of the public or a non-participating trustee shows up at the door and says to Sherry, "I'd like to sit in the boardroom," what's she supposed to say to him?
Then that's when that's why my hand is up. Right now, the public notice that is posted indicates that the public can watch in the lobby of building A, which is the 1260 building. But I'm not so sure. I've never had a trustee come and ask if they can attend in person in the boardroom. But obviously, they're more than welcome.
Well, this bylaw changes all that. That's why I'm.
Yes.
And I think if I could, to Ms. Hampton, I think the question that you were getting at earlier that maybe we kind of talked around, this section of the bylaws does not, it is, and it may need to be clarified a little bit more here. The first section that is struck out covers whether it's in person or it is virtual. That can be true for either. The revision only deals with the virtual meetings, not dealing with in-person meetings. And so if we wanted to adopt this, if this board wanted to adopt this, we would probably need to add some revisions to this, and I apologize for that, to deal with in-person attendance. We don't currently have that, so that wasn't on my radar to, because we don't do our meetings in person at the moment. It was not on my radar to draft that consideration here.
Mary?
Yes, and Michael, is it in what says there is a live broadcast? Is it just practice, or is there a regulation or part of the? I mean, do you have to have live broadcast if the committee wants to not have live broadcast?
No, we are not required to do that. But we do have to provide a mechanism for the public to view the meeting somewhere. We do that by broadcasting it in our lobbies. Doing it the way we do it via live broadcast is just something we've chosen to do.
And we meaning the whole KPPA, or we meaning the KRS, or we meaning who?
KPPA, we do that for all of our board and committee meetings as an agency.
And a committee could choose not to have live broadcast if it wanted to?
I don't know if that's, I've never seen that tried. Only if they meet in person, would they be able to avoid broadcasting it somewhere for the public to watch. If otherwise, we would have to have some sort of mechanism for the public to view that meeting.
Contemporaneously with the meeting occurring?
Yeah, yes,
In real time?
yes. The public
It's
has,
also,
I'm
go
sorry.
ahead, Michael. Go ahead.
Is
I
it-
was just going to tell her it's also filmed. You can go and see it the next day.
Yeah, but they have to be able to attend the meeting contemporaneously with it happened. The public has no right under the open meetings laws. They have no right to participate in the meeting, but they do have a right to attend the meeting.
Thank you.
John?
One of the words in the new sentence says a member should do so by watching via live broadcast. The word should implies some option, perhaps. Is there a better word there?
Well, I mean, we could, I mean, if we wanted to make this mandatory, it could say must or shall. There.
Do you
We could,
suggest?
if the board wants to adopt this, then we could change that to shall is what's preferred in more formal documents. You know, statutes, regulations, they don't like you to use the word must, so shall, making this mandatory. Again, I prefer the conservative approach, so that will be my recommendation. And we can, if the board wishes me to address when we go back to in-person meetings, we can withhold this, we can push this off, and I can address that in some additional language here and bring it back to the board.
Dave?
Yeah, we do have trustees who come to the boardroom, not many of them, who do come to the boardroom for committee meetings and board meetings. So to prohibit a let's call it non-voting trustee from a meeting, prohibiting them from being also sitting in there seems inconsistent.
So, and that's why I offered the option of
Yeah.
going back and addressing the in-person option if when the meetings are in person or if anyone attends in person, and bringing this back to the board.
Yeah, and for what it's worth, we have staff who sit in those meetings too. Not always, but yeah, I think it's a good idea, Michael, to revisit.
Okay.
Ramsey?
Yeah, I was just trying to put it into like real life situation. So is this new rule saying that if the actuarial committee is having a meeting, since I'm not on that committee, I can only watch via Facebook or live broadcast?
That's what it would be saying if the meeting was a virtual meeting, yes.
Okay. I don't think that, I mean, I'm not legal, but it seems strange. I don't think you can, it seems odd to me that you could prohibit a trustee from coming to a meeting. But I don't know. I'm not
Well,
legal. That's
I'm
true.
not, yes, and I'm not saying that it is mandatory. As I said, I take a more conservative approach. The AG opinions say that it is permissible. We just have to have those other guardrails around it to ensure that, to ensure two things. One, that the non-committee member trustee that's attending does not take over the meeting. And two, that they don't turn the meeting's conversation away from something that is supposed to be in the committee's purview to something that is more in the total board's purview. So that's where
Michael?
we have to be careful about that.
Michael,
Yes.
it seems to me that we're using a sledgehammer to kill a flea. And that what we really want to do is what you just said, is we don't want somebody to come in and discuss something not on the agenda. We want everyone to know they don't have a vote. But it seems to me that if somebody wants to go to the meeting and is a trustee and has a comment on the agenda, that would be okay. And we're not doing that.
Yep.
So that's, I want to do what you're talking about, which is prevent somebody coming in and taking over a meeting. Okay. And we want them to know they don't have a vote. And we want them to know any statements made are only to what's on the agenda. So that's my feeling right now. And
Okay.
I want to see what anybody else says.
And
I agree with that. I think any additional trustee that's not on the committee should be treated the same as any public person.
yes, and I don't disagree with that, Ms. Bova, and I think that if we were to go back and address and add some language to this to further flesh that out, the difficulty with what you're describing there about treating them the same as a public person, as a member of the public, that what arises there is in these virtual meetings. Because the public in the virtual setting does not have the Zoom link, cannot attend in the Zoom meeting, cannot make a comment contemporaneous with the meeting. The public is required to submit their public comments prior to the meeting and have them read by Ms. Rankin prior to the meeting. And then they have to watch, as Ms. Rankin said, in the lobby of a meeting on a TV. They can't attend and so that is where doing that, what you just said, in the virtual setting becomes much more difficult.
Okay, but
And
Michael, I don't think if this said any trustee may attend the meeting and does not have a vote, limits conversation to what's on the agenda. It only affects the trustees. It doesn't affect the public. Is that correct?
yes, and so if the board would like, I can go back and revisit this language. Just in the interest of time, I can go back and revisit this language, try to craft something that more directly reflects the discussion we've had today about what the board wants here. That would provide some of the guardrails from the AG opinions, but not prohibit the attendance of a trustee, but would put up the guardrails which the AG opinions say should be there.
Okay. Is there any other discussion? I would suggest that we look at this and someone either make a motion to accept the change of the bylaws or make a motion to table the motion. Well, it's not, we haven't made a motion, so I guess just table the issue until a future meeting. So let me see what you all would like to do.
I mean, if there's no motion, there's no need to table it.
Yes, correct.
It could just be passed. The topic could just be passed to be brought up at another meeting.
Okay, Michael, since it's on the agenda, do I need a motion or can I just say that?
You can just say that. You don't need a motion
Okay.
for that.
Okay, if there's no objection, I say pass this to a future agenda. And Michael, I think you have heard from a number of us on the issues that we were concerned about. So
yes,
okay, that would be great. Okay. So thank you. And thank you for bringing it up and bringing a lot of things to our attention. Okay, John, you're up with the CEO report.
Yes, thank you. We only had a couple of weeks between this meeting and the last meeting. So my report is rather brief. I've participated in a legal update since the last meeting. I attended the PPOB meeting as well, and the board and committee meetings that have occurred in the interim. And as a final thing, I would note that I have continued to work on the organizational issues that I've discussed with each of you in the past and will continue to do so. So that's my report there, Lynn.
Thank you. Any questions of John? Dave, on to you, the KPPA update. I mean, I'm sorry, Dave, you're taking the KPPA update.
Yes, and I provided the written update in the board books. I would say if anybody has a question at the moment, I'd be happy to address it. Or if they want to call me later and discuss their or raise their issue, I'm happy to take that call.
Any questions?
You know, and I'd say further, you know, I hope the trustees find the time before the meeting actually to read John and my comments.
Okay, any further comments? Okay, we have new business. And the only thing I want to add to new business is I want to thank the staff for continuing to work on finding office space for our investment staff, and appreciate the reports that you're giving. And so thank you very much, and let everybody know that that is an issue that's staff is addressing. And there are a number of complications that deal with the state government and making sure we can lease space. Okay, any other questions? Okay, with that, we'll move into closed session. And Michael, in the order of this, do we get the motion first and then your statement? Is that how that goes?
We get the motion, the second, and the vote, and then the statement.
Okay, so is there a motion to move into closed session pursuant to KRS 61.810 to discuss pending litigation?
So moved. Second.
Okay, thank you. I guess Sherry got the second on that. Any discussion? And then Michael, if you can give us the legal statement.
A motion having been, did I miss Hampton? Did I hear?
No, you didn't. I didn't.
Okay.
Okay, I need there's a motion on the floor. I'd like to have those that approve the motion say aye.
Aye.
And opposed. Hearing none, no opposition. Michael.
A motion having been made in open session to move into closed session for a specific purpose, and such motion having carried by majority vote in open public session, the board shall now enter closed session to consider litigation pursuant to KRS 61.8101C. Because of the necessity of protecting the confidentiality of the system's litigation strategy and preserving any available attorney-client privilege.